Today we're talking about one of the most important ideas in trading, the mindset shift that takes beginners from emotional, inconsistent decisions to controlled, confident, and consistent trading. Most traders lose money not because they lack knowledge, but because they lack the right mindset. By the end of this video, you'll understand the mental framework professional traders use to stay disciplined, handle losses, and build long-term consistency. Let's begin. Blank. 1. The mindset shift. From making money to managing risk, most beginners enter the market with one intention: to make money fast. They look for the biggest move, the flashiest setup, or the next easy win. But professionals think differently. Their first priority is capital preservation. They don't wake up asking, "How much can I make today?" They ask, "How can I protect my capital today?" When your focus switches from chasing profits to managing risk, everything changes. You take fewer reckless trades. You respect your stop loss. You stop forcing trades that aren't part of your plan. It sounds simple, but this shift is the foundation of consistency. If you survive long enough in the market, the profits come naturally. The goal is not to win big, the goal is to avoid losing big. 2. Emotional discipline. The battle every trader faces. Trading triggers every powerful emotion in the human brain: fear, greed, uncertainty, hope, frustration, excitement, and doubt. If you can't control your emotions, the market will control your decisions. One of the biggest emotional traps is FOMO. The fear of missing out convinces beginners to chase moves that are already over. But opportunities in the market never disappear. There will always be another setup. What matters is avoiding the ones that destroy your discipline. Another emotion is the fear of losing. Beginners freeze when a trade moves against them. Instead of cutting it, they hope it will reverse. Consistent traders accept losses quickly and professionally. A small loss is a business expense, nothing more. Then there's revenge trading. After a loss, beginners want to get it back. They jump into impulsive trades that have nothing to do with their strategy. Professionals never chase the market. They reset, recenter, and wait for their edge. Emotional discipline doesn't mean you stop feeling emotions. It means you stop letting emotions make your trading decisions. 3. Cognitive biases that influence your trading decisions. Your brain is wired to survive, not to trade. And if you allow your natural biases to guide your decisions, you will make emotional, irrational choices. One major bias is confirmation bias. This is when you look only for information that supports your trade and ignore everything that contradicts it. Traders who operate this way want to be right instead of being accurate. Another bias is anchoring. When an asset was recently at a higher price, traders assume it must go back. But the market doesn't care where price used to be. It only cares where it is now. Overconfidence is another dangerous bias. A few wins in a row can make you feel unstoppable. That's when traders start increasing risk, removing stop losses, and taking setups they would normally avoid. Overconfidence has destroyed more accounts than bad strategies ever will. Then comes loss aversion. Losing hurts twice as much as winning feels good. Because of this, beginners hold losing trades too long and take profits too early. Professionals do the opposite. They cut losses quickly and let winners grow. By understanding your cognitive biases, you start to see the market clearly rather than through emotional filters. 4. The risk management mindset. Risk management is not a tool. It's a mindset, and it's the single reason professional traders survive while beginners blow accounts. Consistent traders never risk more than a small percentage of their account on any trade. By keeping risk low, each trade becomes just one of many, not a life or death event. They always use a stop loss. A stop loss isn't a sign of doubt, it's a sign of discipline. It proves that a trader respects their capital more than their ego. Position sizing is another key element. Even a great strategy becomes dangerous if the position size is too large. Professionals size their positions based on volatility, strategy, and account size, not emotion. Most importantly, consistent traders understand that trading is not about frequent action. It's about waiting patiently for high-probability setups. Trading more does not mean making more. Trading smarter does. 5. Patience. The most underrated trading skill. Patience separates impulsive traders from consistent ones. Beginners feel like they must always be in a trade. They fear being left behind. But professionals know that waiting is part of the job. The market pays you to wait for your edge. Patience is noticing when the market conditions aren't right and choosing to sit on your hands. It's refusing to trade out of boredom, frustration, or excitement. It's understanding that doing nothing is sometimes the most profitable decision you can make. Consistency is built through selective action, not constant action. Blank, underscore, blank. 6. Confidence. Built by data, not emotion. Confidence in trading doesn't come from hype, luck, or positive thinking. It comes from data. Professionals track their trades. They know their win rate, their average return, their drawdowns, and their strengths. With this information, they trust their system because they've proven it. Beginners lack confidence because they rely on guesswork. They're always adjusting their plan, switching indicators, and doubting their entries. True confidence is not, I feel good about this trade. True confidence is, I know my system makes money over time. Confidence is not emotional. Confidence is statistical. Blank, underscore, blank. 7. Handling losses like a professional. Losses are unavoidable, but how you respond to losses determines whether you become a consistent trader or stay stuck as a beginner. Professionals do 3 things. First, they accept losses instantly. They don't negotiate with the market or move their stop loss. The loss is taken and documented. Second, they detach emotionally. A loss is not a personal failure. It's part of the business. The goal is not to eliminate losses, it's to control them. Third, they reflect. They ask, was this loss part of the system? Or did emotion influence it? If it was part of the plan, they move on. If it wasn't, they adjust their behavior. The difference between beginners and consistent traders is not the presence of losses. It's the professionalism behind every loss. Blank, underscore, blank. 8. Building mental resilience for the long term. Resilience keeps you in the game long enough to see results. Markets will go through unpredictable phases. You will have drawdowns, losing streaks, emotional days, and periods of self-doubt. Consistent traders survive these phases because they understand the bigger picture. Resilience is built through routine, having a structured plan, reviewing your trades, and showing up with discipline every day. Resilience is built through acceptance, understanding that uncertainty is not the enemy, it is part of the system. Resilience is built through consistency, small wins, controlled losses, and steady improvement. When your mindset becomes resilient, short-term outcomes stop affecting your long-term vision. Blank, underscore, blank. 9. The final mindset shift. From trading to becoming a trader. Beginners treat trading like an event. They want fast results. They want excitement. They want to feel something. Consistent traders treat trading like a professional skill. They focus on process, not outcome. They follow a routine. They execute their plan. They improve gradually. The real transformation happens when you stop trying to make money and start trying to make good decisions. When your focus shifts from results to process, your results finally become consistent. Blank, underscore, blank, underscore. If you want to become a consistent trader, the journey begins in your mind. Shift your focus from making money to managing risk. Develop emotional discipline. Understand your cognitive biases. Master risk management. Practice patience. Build confidence through data. Handle losses like a professional. Develop mental resilience. Trading is not just a skill. It's a psychological discipline. And once your mind aligns with the market, your results will follow.